Hello and welcome to Portfolio Matters Weekly Update, Week 31. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Take it away, Keith.
Thank you, Richard. Well, before we get going this week, we were contacted last week very nicely by a viewer, Andrew M., who made a very kind offer to donate £250 to the cause. And Richard and I are currently trying to find ways to facilitate this very generous donation, which we take as a great vote of confidence in what we're doing. And hopefully we'll find a way of facilitating this without too much cost. And if other viewers wish to also contribute to the cause, which we will put to research and subscriptions, then that would be most welcome.
Indeed. Thank you very much, Andrew M.
Okay, moving on. This week's economic updates. So the big news of the week was the Bank of England meeting. And the Bank of England, like the Fed, talking about tapering. But despite inflation beating all their previous forecasts, they did nothing. So they left rates unchanged and they left the QE program unchanged. So elsewhere, we had Chinese manufacturing PMIs. They came in at 50.3, i.e. just in expansion. And that was down on June and below expectations. However, the good news is that the services PMI bounced strongly. So that came in at 54.9, well above June and well above expectations. And as services are larger than manufacturing, that meant the composite PMI bounced strongly as well. It came in at 53.1, which is much higher than in June and again, well above expectations. So that is all very positive for the world economy. In the US, the ISM manufacturing PMIs came in at 59.5, which was slightly below June and below expectations. So further evidence that the growth pulse in the US is fading. However, non-manufacturing PMIs bounced very strongly. So July number was 64.1, which is well above June and well above expectations. So that's very encouraging. Unfortunately, the other parts of the non-manufacturing survey were less encouraging. So they were reporting very high prices, input prices. So 82.3% of respondents were reporting higher input prices, and that's up on June. But they were also reporting good employment outlook. So the percentage of respondents reporting that they were going to be hiring was 53.8 compared to 49.3 in June. And there was also manufacturing orders numbers for June, month on month. They rose 1.5% in June, which is down from May, but still that is a good annualized rate. In the UK, we had construction PMIs. July number was 58.7, which is still good, but was well down on June and unfortunately below expectations. So looking at a few charts. Well, the big news item of the week was the Bank of England meeting. And this shows the Bank of England's inflation forecasts over time. So the February forecast was for slightly higher inflation in this year and the next year. So inflation peaking about 2.5%. 3 months later in May, they were saying inflation is going to peak at 2.5%. Now they're forecasting it's going to peak about 4%. And they've done absolutely nothing. No change in either interest rates or QE.
I think the problem here, Keith, is that they're professing a degree of accuracy and ability that simply doesn't exist in the real world. And, they're producing these precise forecasts with basically, we don't really know what's going to happen to inflation because there are so many moving parts.
Absolutely. Well, their forecasting record, you can see right here, has been terrible.
Yeah.
And one of the policies that the US has brought in was average inflation targeting. So they're now aiming to have 2% average inflation since 2009. That would allow the US to run inflation above 2% for a period to get back to a higher average inflation of 2%. That won't work in the UK because we have had high inflation since 2009. So this compares the inflation experience in the UK with the US and Europe. And you'll see we've had high inflation throughout the period, actually much higher than the 2% inflation target.
This chart is all cumulative gap, isn't it, Keith? So
yes, that's right.
It means that the Reichsbank has a 10% gap that it's got to that it can fill if it so chooses to. So it could run. My understanding is if the Reichsbank, if German inflation was 10% for a year, that would bring it back to zero.
Yes, that's exactly right.
So I mean, they have cut themselves a vast amount of slack here.
Yeah.
In inflation levels by introducing average inflation targeting.
Yes, precisely. Except for the UK.
Except for the UK, yeah.
Yeah. Okay, so this is China's manufacturing PMIs, which you can see fading, unsurprisingly, frankly, given massive input price inflation, particularly in energy prices. But the service PMIs are rising and bouncing nicely. So, last month we would have been extrapolating this down and it would have been looking quite negative. This month, much better. And as a result, the composite has bounced. In the US, manufacturing PMIs, it's fading, but we have had a very nice bounce in the non-manufacturing PMIs, and that is very encouraging. And last week, there was a big drop in continuing jobless claims. So the US employment market is continuing to heal. And last week, we included this chart, and we were talking about how the line appeared to have plateaued, and suddenly it's taken a dip down. So the US employment market is healing. And this is UK construction PMIs, which are down from previous highs, but still strong on a historic basis. Okay, so this week I wanted to talk about the EU carbon trading scheme, because the price of carbon credits in the EU has gone through the roof. You'll see back in 2017, they're trading around about €5, and now they're up 11-fold from that period then. Now, the EU are claiming that the emissions trading scheme has brought down carbon emissions by 43% over the last 16 years, and they are committed to using this to achieve the further cuts in carbon emissions over the coming years. Now, what does it do? Well, if you emit carbon in the EU, you will have to buy carbon credits to offset those emissions, and it affects the following sectors: electricity and heat generation, i.e. power plants, and then basic industries such as oil refineries, steelworks, iron, aluminium, metals, cement, lime, glass, ceramics, pulp, paper, cardboard, i.e. basic industries. And there are big penalties for non-compliance. So if you fail to buy the correct credits, you will be fined 110,000 euros per ton of carbon dioxide emitted, plus any shortfall in permits that you've incurred this year will be rolled over to next year. So this year, if you fail to buy 100 tons worth of carbon credits, next year you'll have to buy the amount you should have bought plus 100 tons. Plus there's a name and shame sanction. And what's going on is previously the EU had issued more credits than was required by the system, but now we're going into deficit. There won't be enough. And that deficit is forecast to grow. So we are here, 2021, and Lawson Steele, who we're getting all this information on and who specializes in discussions of the EU carbon trading scheme, is saying that actually we're going to be in shortfall for around 25 to 30% of carbon credits this year, which is causing that big squeeze in the carbon price. But above all, this is a short squeeze. If everyone now needs to buy more credits than are actually available, then the price could go very, very high. And
what it can also, sorry Keith, what it can also do is it can cause manufacturers basically to cease production because they become totally uncompetitive.
Precisely, that's where I was going next, Richard. Thank you. So this is his view of the cumulative shortfall over the coming years. And as Richard has just said, that means that some businesses will become uneconomic, particularly compared to imports, which don't have to pay for these carbon credits. Now, there is a market stability reserve, but it's small. So what the EU have done is previously, when the price was very low, they took some credits out and have kept them in reserve, and they will release those over the next few years, but it's small. And in August, and we're now in August, the supply of carbon credit drops 32%. So this is live right now. And as a result, Lawson Steele is forecasting the carbon price to go through the roof. And the only reason it drops later on is he thinks that the very high price will be unacceptable, politically unacceptable. You will get pushback.
Yeah. So there's an article in the FT today, Keith, about yesterday actually, of course. The Spanish government is complaining to the European Commission about the cost of energy for its domestic customers because of the carbon credit pricing system. And so there's becoming significant political pushback already.
Yes. And as we'll see in a minute, Richard, when we go through the charts, German energy prices are already stratospheric, and this will only push them up further. I just can't see how it's going to be politically acceptable to continue withdrawing carbon credits from the scheme and putting the price through the roof.
Yeah. At a time also where households, families are being squeezed by inflation in any event, and for energy prices to be going up significantly. There are UK price rises. I know we're not in the EU carbon credit scheme, but there are UK price rises in the offing as well for energy.
Yeah. So, in summary, the rise in the carbon price will disadvantage EU basic industry compared to imports. Now, the EU are aware of this, and there is an EU carbon border adjustment mechanism which will come into force from 2026, which will force imports from elsewhere, importers to buy carbon credits just like EU manufacturers. But until then, and that's 5 years away, EU manufacturers will be at a big disadvantage. And I just can't see this being maintained. The EU are going to have to step back, I think.
But until they do, the carbon credit market appears to be a sound investment.
Yes, but again, it's like
when they adjust it, it could become problematic.
Exactly. Yeah, you're in the hands of the politicians. Is that where you want to be?
Yeah.
Okay, and the other thing I want to talk about this week was inequality in the US. We had some charts from Lynn Alden, which I thought were really interesting. So this is the percentage of national wealth held by the top 1%. And you can see that the US is the most unequal of any major advanced economy. And so the UK's inequality has actually declined somewhat over the period since 2000. In comparison, inequality in the UK has been broadly flat, and nowhere else do you see this trend of increasing inequality. And this chart shows that in the US, the wealth of the top 1% almost equals the wealth of the bottom 90%, which is extraordinary. And the reason that inequality has grown so much in the US is that wages have not kept up with productivity growth. So in effect, US workers are failing to capture their contribution to national wealth. And this is the chart showing the growth in hourly compensation since 1980s in real terms. And you can see essentially wages have largely stagnated while productivity has massively increased. So as a result of this, the median male income now fails to pay for family expenses. And if you look at this, you'll see a large contributor to that decline in essentially living standards is the massive increase in the cost of healthcare. So it is now, according to these figures, a single parent in the US cannot afford to run the household.
Interestingly, Keith, I think, if you go back 50 years to our parents, many households ran off one earner, the husband, yes. And the wife stayed at home and looked after children. That's really quite an unusual model now, and it's because as a general change, I think it's because incomes have dropped relative to the expense of running a household. Absolutely.
And so this chart shows a great deal of unhappiness. Essentially, people are struggling to make ends meet in the US. Meanwhile, the average CEO earns 200 times that of the average worker. So, I mean, I just think this is a recipe for social unrest and revolution. They're going to voted in Biden, and Biden will attempt to rebalance the economy in favor of workers. Now, on to other charts. So we saw earlier how the UK Bank of England had not raised rates in the face of much higher than expected inflation. And one of the things they discussed was wage inflation and the shortage of workers. So this is the standard deviation of companies reporting difficulty in hiring workers. So basically, lots of companies are saying they're finding it difficult to hire workers, which means wage pressures will rise, which means inflation will become embedded. And talking further about inflation, now I thought these were really interesting charts from the US. Now, the top chart shows the percentage of banks in the US reporting that they were tightening lending standards. And you will see during the COVID pandemic, they all tightened lending standards, and now they are loosening them. The middle chart shows the percentage of banks reporting that they are tightening spreads on loans. And you'll see again, during the COVID crisis, they increased their spreads, so they made loans more expensive. And now they are tightening spreads. They're making loans cheaper. And as a result, the bottom chart shows demand for loans. And those loosening of lending standards are now feeding through to an increase in borrowing. And that's really important. Credit expansion equals an increase in the money supply, and loan growth equals an increase in the velocity of money, when we know we have had a massive increase, a 30% increase in base money over the course of the last 18 months. So that's inflation.
Yeah.
And these are the monetary aggregates in the US, and you'll see, money growth, money supply growth is still very strong. And in order for you not to get inflation, you need to have a collapse in the velocity of money, and loan growth equals an increase in monetary velocity. And further evidence that Americans are still borrowing. This is home equity withdrawals. And as house prices rise to new records, Americans are withdrawing equity and spending it.
Of course, that's exactly the same effect as bank lending to businesses, isn't it? It's putting more debt into the economy and ensuring that there's more money chasing the number of goods.
Yep, absolutely. Increasing the money supply. And this German inflation expectations, and they are rising quickly, but they're not yet at 2%. I thought this was an amazing chart. This is German energy prices. And as we discussed earlier in our carbon pricing discussion, this will only rise.
Ooh. And they've done it in 5 months.
Precisely. So everywhere you're seeing input inflation. But bund yields remain very low and very negative. In the 10-year, minus 0.5%, best part of, and they're falling, which is just incomprehensible to me. And this was a really interesting article in the FT this week, talking about supply bottlenecks and how the ports of the US were just absolutely overflowing with containers and having difficulty dealing with the record flow. So they were talking about how one container will hold 79 electric fireplaces. Now, last year, it cost $4,500 to move that container from China to the US. This year, if you can find one, it will cost you $20,000. And that represents an increase of $200 per fireplace. Inflation. And the thing is, if the throughput in containers continues at this level, then you will have to expand the port. That takes years, and inflation could be persistent.
Also, that's both inflation, as you say, Keith, but it also at some point starts to question the raison d'etre of making these things abroad, because the cost benefit of doing so gets eroded by the cost of shipping.
Yes, reshoring becomes possible. Container rates continue to shoot for the moon. Essentially, they're not coming down at all. Now, we previously talked about home equity and rising house prices, and the house prices in the US are being supported by the Fed buying mortgage-backed securities. And you can see there seems to be a good correlation between Fed purchases of MBS, which is the dark blue line, and the house price index, which is the kind of bluey purplish line. And why the Fed is continuing to buy MBS when house prices are surging at an all-time high mystifies me.
Well, I think it's part of their strategy to give the economy two legs, Keith. It's the stock market and the property market, and to make sure the sensation of wealth persists.
Well, we saw last week, Richard, that very high house prices in the US are now counterproductive because they're putting off buyers. And, moving house is a key driver of demand, because if you move house, you buy new curtains, new furniture, etc. And so I think this is another piece of evidence that very easy credit conditions are now counterproductive.
Yeah, they cause problems. They create bubbles. And then the bubbles. If you're gonna burst a bubble, it creates a big problem that is politically and economically untenable at the present.
Yeah.
And this graph is extraordinary, Keith. The inflation surprise index. I don't think we're surprised particularly, because we've been talking about this for months. But clearly, this is a surprise to many people.
Well, it's a surprise to the Bank of England, Richard, but they are committed to doing absolutely bugger all about it.
Yeah, very true, Keith.
And this is the economic surprise index,
which is below zero.
Yeah, that's right. So getting negative economic surprises, but then we're having a resurgence of the Delta variant, etc., etc. And there are a lot of hangovers from COVID. And as we've seen from the non-manufacturing PMIs, they can bounce back.
Yeah.
So this is further evidence of the extraordinarily loose credit conditions in the US. The blue line is global PMIs, and the pink line is Treasury yields. And so we've talked previously about how far below the Taylor rule US monetary conditions are, and this is further evidence. And as a result, we've had record inflows into inflation-protected securities in the US as investors become increasingly worried about inflation. And talking about the gap between inflation expectations and bond yields, you see that currently there's this enormous gap between future inflation expectations and actually bond yields, which are very low. Now, this has happened before. This happened back in 2012, 2013, during Bernanke tapering era, and it was resolved when bond yields rose to meet falling inflation expectations.
But on this occasion, Keith, I don't think that the Federal Reserve will allow bond yields to rise. I think that they can't afford to. There's so much debt in the economy.
Well, but it's only partly in their hands, Richard. At some stage, if investors become concerned about inflation, then they will demand higher bond yields. Having said that, they haven't so far, which is completely mystifies me. But we will go into this slightly later. So as a result, now, previously, Richard was talking about stagflation, the big dangers of stagflation, and I pushed back on that because I said that if the market became concerned about inflation, then it would demand higher yields on bonds, and which would raise the cost of borrowing, and that would force the economy back into recession. So instead of stagflation, you would get economic volatility. But I've been wrong so far in that the market inflation has risen and bond yields have actually fallen. So it looks like we're in a stagflationary environment right now.
I think there are two issues we have to think about, Keith. One is that, in my view, and I've held this view for a long time, as viewers know, there's no way that we've gone through the coronavirus pandemic and all of the upheavals without causing massive economic damage. It's there. it's been hidden by government spending, but it has to be there. It can't not be there. That's the first thing. And the second thing is that if you take GDP growth and subtract from it the rate of inflation, real GDP is negative, which is a recession. So I would actually argue that we are currently in an inflationary recession, which is stagflation.
I disagree with you on the GDP growth, Richard. We disagree about the calculation of inflation, but anyway, I certainly take your point that growth is slowing and inflation is picking up, and that is definition of stagflation. Essentially, was where we are now, and what mystifies me is the response of the bond market. But anyway, if we're in stagflation, you need to hold inflation protected assets such as commodity real estate tips.
Yes, and I'd just be wary of cash there, because clearly you don't want to hold cash if there's a lot of inflation around.
Yeah. No, this slightly mystifies me, this here, because if you've got very high inflation, the last thing you want to hold is cash. So why that's there, I just don't know.
I think cash should really be around about 5 o'clock, shouldn't it, on that
Yes,
circle?
Precisely. So when stagflation causes a market crash and a recession, then you want to hold cash, but it's not now. Okay, so this is a chart showing the performance of average rallies in the S&P 500 in previous recoveries. And it shows that after a very strong initial recovery, you get this period of essentially flat returns before the market continues higher. And the red line is the current rally, which is outperforming that. And can that continue? Are we due a period of consolidation?
Who knows?
Now, finally, on coronavirus. So this chart shows that in India and the UK, the Delta surge lasted for around 50 days between start and peak. Although you'll notice defining the start is questionable. And so we are now getting the Delta variant surge in the US. And based on my rough calculations, if by analogy with India and the UK, we would expect the Delta variant surge to peak in late August, about the 25th of August, if the analogy holds. Yeah. And finally, I just thought this is very interesting. This is from the FT this morning, and it was talking about autonomous killer robots. And these are STM Cargo 2s, which are manufactured by Turkey. And the UN are saying that these autonomous flying drones, which each carry a 1 kilo payload, were used in the war in Libya autonomously to hunt down people. So you'd set it off, and you'd say, go and find somebody and blow it up. And they will blow him up or her up, and they will hunt them down and do just that.
Scary.
Absolutely. The Terminator is here.
Yeah.
Okay, so moving on to checklist. Well, it was broadly a good week for the markets. The all share was up 1.3%. The stocks Europe was up 1.5%. S&P continued rising, up 0.8%. The NASDAQ was up 1.5%. Topics in Japan is up 1.5%. Bitcoin continued higher, up a further 4% after its extraordinary performance last week. And sterling also rose up to 139 against the dollar. Now, this is the NASDAQ, and you'll see that, the dot-com bubble looks an absolute pimple. And as a result, the number of companies the total market cap of companies in the US with a price to sales ratio above 20 now eclipses the dot-com peak. And I would just like to remind everyone of the comments of the CEO of Sun Microsystems in the aftermath of the dot-com bubble, where he commented on the valuation of Sun Microsystems at 10 times revenue. Okay, bear in mind that last chart was 20 times revenue. And he said, at 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard for a company with 39,000 employees. That assumes I pay no taxes, which is very hard. That assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes zero R&D for the next 10 years. And I have to maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any kind of transparency. You don't need any footnotes. What were you thinking? So if you're buying companies at a price to sales ratio of 20 times, what are you thinking?
You are thinking that someone is going to buy it off you at a greater multiple than that, Keith.
Well, so
that's
far,
the only logic.
Yeah, it's going up, Richard. What can I say?
Bitcoin. Well, Bitcoin's had a good couple of weeks, actually. It's up by 30% from its recent low. And Ethereum, on the next slide, which was basically was the one that showed the real head and shoulders pattern. Rather looks like the head and shoulders pattern has been negated because the price now is the same height as the original shoulder on the right-hand side. So I suspect that Ethereum is not going to drop, as you would expect for a typical head and shoulders pattern. We've been discussing this for the last few weeks. And I put in a log chart of Ethereum, which is quite interesting. If you believe in these things, it's in the middle of its log channel, and it's going to go up to probably 8,000 on the basis of if it hits the top of the channel line. And now, clearly, this is entirely speculative. I'm not saying it's going to, but if you believe that it is actually in a logarithmic channel, then that is what you would expect to happen. And the shit perp chart is picking up nicely, I think you could say. It tends to be a follower of Bitcoin, and it does look, in some sense, it looks sort of like a combination of the Bitcoin and the Ethereum chart.
Very good, Richard. It's the shit perp chart has had a distinct bounce.
It has.
Okay, on to industrial commodities, and it was a mixed week. So aluminium rose 1.1%, cobalt was flat, copper fell 3.6%, chromium was down 0.9%, iron was the big mover, and we will discuss this. Iron was down an enormous 8.4%, and that was on top of falls last week. So iron is really coming off now. Lithium rose 3.9%. Neodymium crept up further to new highs, up 0.7%. Nickel fell, down 2.5%. Ferrovanadium was flat. Crude oil fell 6.1% as the market had been expecting a big draw in inventories and got a small one. Coal continued its relentless rise, up 4.1%, and uranium was down slightly. This is the chart of Bernstein's forecast for oil demand. And what they have done is they have assumed that all the government mandates for electric vehicles are enforced and that diesel is increasingly substituted for hydrogen fuel cells. And assuming that the energy transition goes to plan, they are saying that oil demand won't actually peak until the mid-2030s. So we'll be in the oil age for a while yet. And that matters because oil companies have cut back on their expenditure and their exploration despite record cash flows in the last quarter. And the energy sector is now a tiny part of the S&P 500. And the other thing is not just private companies, the majors, which have been cutting back on exploration and production. It is actually OPEC countries themselves. So this is the change in production capacity for OPEC companies over the last over the last 3 years. So from October 2018 to now, and you see the UAE has grown capacity, as has Kuwait, but overall there's been a big drop in production capacity, and that matters going forwards if oil demand continues to rise as Bernstein are forecasting. And on that note, this is a chart from Carios, who use satellites to monitor the levels in storage tanks around the world. And they're saying last week there was an enormous draw around the world of 28.5 million barrels in that week alone. Now, in the US, there was quite a small draw, but they're saying in the world as a whole, there's been a big drawdown.
This is the container-sized battery fire in Australia. It's a lithium-ion battery. It's one of these bulk storage facilities that's built by Tesla, much vaunted, and it is the lithium battery. And the difficulty apparently with lithium battery fires is you can't put them out. What you can do is you can try and keep them cool so they don't spread, but you can't put them out because apparently the fire itself produces oxygen, I was reading. So they are very difficult to contain, control. And clearly the danger there is that it would spread to the next containers and you get a chain reaction, the whole thing goes up. Now, apparently they've shut this plant down for the time being while they work out what went wrong and what they need to do, which is obviously a very sensible thing to do. But it does make you wonder whether the lithium-ion battery has sort of reached the end of its useful developmental life and something more sophisticated is A, required, and B, will actually ultimately be developed. It doesn't require such enormous quantities of organic solvent, I think, which is the electrolyte. Yes. So I think this is one to watch, and I know that there's a lot of investment currently in lithium mining and lithium and so forth. And you do wonder whether this might actually be quite late on in the game for the lithium-ion battery now.
Well, you would hope that they developed an inflammable electrolyte. But looking at this presumably should be good for vanadium flow batteries if they can get the price down.
Yes, I think that's right.
So moving on, this is aluminium. Aluminium is going through the roof. And on the back of that, Trafigura, who are a commodities trading house, are saying that after years of a surplus in the aluminium market, we are now going to move into deficit. So aluminium production capacity will now not meet demand over the coming few years. And that is very bullish for aluminium and inflationary. Cobalt is near highs. Copper has come off a bit, but is still very elevated. Now this is iron ore. Now iron ore is coming down sharply from this peak. And what is going on? Well, it's all down to the Chinese government. Essentially, the Chinese government have told steel mills that they will have to limit production in 2021 to a maximum of their output last year. So they can't produce any more than they produced last year. But in the first half, they increased production by 12%. And that means they're going to have to cut their production by about 10.8% in the second half in order to meet that government mandate. and that will reduce iron ore demand, sending the iron ore price plunging. This is lithium. Neodymium is creeping up to new highs. Nickel doing well. These are all 10-year views. So nickel had a bad week, but on a 10-year view, on recent history, it's still doing very nicely. Thank you very much. Crude had a bad week, and its price is now back to 2018 levels. But if inventory draws continue as forecast, then medium term, I'm expecting the oil price to move higher. Coal is absolutely extraordinary. So that has trebled in the last 9 months, and we are seeing real world effects of the very high coal price in that.
And that probably, yes, I was going to say, that probably explains Germany's energy price, doesn't it? Because it's very dependent upon coal since it closed its nuclear power stations. Absolutely.
And also steel prices are going to go through the roof.
Yeah.
And steel is a basic commodity used in everything.
Including wind power.
On to precious metals. Well, it was generally a poor week for precious metals, despite the rise in inflation and despite the fall in bond yields. So gold was down 1.2%, silver was down 1.2%, platinum was down 3.9%, but rhodium bounced up 3.3%, and palladium was up 1.1%. So this is the gold price over the last 10 years. And despite rising inflation, it really hasn't moved recently. And silver is also quiescent. Platinum is coming off. Rhodium has had a big fall from its highs, but appears to have stabilized in recent weeks. And palladium seems pretty stable towards its highs, actually. Finally, rates. Well, despite inflation coming in hot everywhere, bond yields continued to fall. And the UK 30-year now yields 0.95% for 30 years. It's absolutely extraordinary. And this is the UK 30-year gilt. And you'll see the yield is really falling back to the depths of the coronavirus crisis. And in the US, we are seeing a similar pattern, bond yields falling. Now, one possible explanation for all this is Donald Trump, before he left office, massively increased the size of the Treasury General account. So essentially, he issued loads of bonds, and that all the money raised from the issuance of those bonds went into the Treasury General account, and to an absolutely extraordinary extent. The Treasury General account essentially exploded to multiples of the highest level it's ever been previously. And now it's being run down. Now, in this period in which it's being run down, the US government doesn't have to issue any treasuries because it's essentially pre-funded itself. And so what may be happening in the market is that there's demand for bonds and the US government isn't issuing any. So we are seeing a slightly artificial market, and soon the US is going to have to start issuing bonds again, and the market may normalize. And this is the seasonal chart. We are at the beginning of August. So if this holds, you can expect a little blip in the middle of the month.
Fingers crossed. So I had a slightly better week this week, up 0.8%. Mostly, I think, because the falls have stabilized as opposed to anything particularly doing very well. I didn't make any purchases or sales. And the only chart I wanted to bring people's attention was the Graphene Manufacturing Group, which you remember I bought a couple of weeks ago. I bought it at about a price of about 2.3. This is Canadian dollars. And immediately after I bought it, it dropped by 30%. and but it is now going back up. And I was actually looking at a presentation that they did at the end of July, which is really very interesting. And if anyone is interested, go to the Graphene Manufacturing Group and look at the chief executive's presentation. And I would suggest, we were talking about lithium batteries and have they reached the end of their technological lifespan. And I just think this is an interesting concept. They only make tiny batteries, the coin-sized batteries at the moment. So that's my update, Keith.
Thank you, Richard. Well, I also had a good week. The oil companies bounced despite the sell-off in crude. So crude was down, oil companies were up. And actually, at one stage in the week, they were doing much better than they are now. On the back of BP results. And that takes me up 4% year to date, which is very disappointing, underperforming Richard and Stuart and the all share by a big margin on the back of the poor performance of energy. I did no purchases and no sales. Now, the one thing that I wanted to talk about this week was I've had a winner in my my tax avoidance or tax management.
Not tax avoidance, Keith.
Yes, not tax avoidance. If any tax inspectors are listening, not tax avoidance. I mean tax management or whatever. So the EIS scheme means that you can invest in startup companies and get very substantial tax breaks. So if you were to invest 100 grand in an EIS company, you get 30 grand back off your income tax immediately. You then can defer capital gains tax of up to 28%. So it's treated as though the capital gain is rolled into the EIS scheme. You can also defer, write off inheritance tax of up to 40%. So if you add all that up, you can actually defer something like 98%. But I mean, that does assume that you can get back inheritance tax.
It also assumes you've died, doesn't it, Keith?
Well, yes, okay. That's true. But anyway, assuming the other ones, then, I mean, frankly, the only ones I used were the income tax relief at 30%, but also the CGT deferral at 20% rather than 28%. I think 28% is for property, isn't it? Rather than shares, which are 20%. Anyway, so in 2016, I invested in a video games developer called Outright Games via the broker Rockpool, and I added to it in the second round in 2018. And I'm told, I haven't got the money yet, but we've sold to private equity for an exit multiple of 12 times, which is very nice.
Congratulations, Keith. Well done.
Yes, thank you very much. And if you include the income tax relief, that is 17 times. Now, Richard and I do some angel investing, and we have yet to have an exit. We have had a failure, but you don't have to have many of them go right for this to work. If you're willing to put in the time, the effort, and have the patience to wait for a minimum of 3 years. But the reality is 5 to 8 on average. Other things in the news in my portfolio, this is the share price of Cairn Energy, which we've talked about previously. Now, Cairn Energy was a victim of the Indian Tax Terrorism Department, who seized 10% of Cairn India and sold it off back in, I think, 2018, or was it 2012? And as a result, Cairn Energy took them to court in the Netherlands and won an injunction fining India $1.2 billion. And Cairn Energy have then gone around the world attempting to seize Indian assets. Now, yesterday, India blinked and it said it would unwind the tax laws which had allowed them to retrospectively seize the assets of both Vodafone and Cairn Energy, and Cairn Energy's share price surged. Now, sadly, the share price has actually come off quite a lot in the last 6 months, and that only takes me back to about where I bought it. But anyway,
It's a good sign,
outcome.
though, Keith. It's a good sign.
Yes, exactly. And finally, BP. So BP, like Shell last week, had good Q2 results, raised the dividend by 4%, and announced a 1.4 billion share buyback program. And over the course of the last year, its debt has come down from 51 billion to 32.7 billion. So a massive cut in debt, admittedly partly through asset sales. But if oil prices continued high, the majors will throw off a lot of cash.
Yeah.
And that is it for this week. Thank you all for listening. And thank you once again to Andrew M. for getting in touch and saying how much he appreciated this program with a donation. And I hope you will press like and subscribe to the channel. And it is goodbye from Richard Weiser.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.